Hiya, I'm Elliot from Free Life Financial, and today I'm going to be talking about deposits. This is just about the first thing you need to consider if you are going to be buying a property with a mortgage. Before you can really start the process at all, you'll need to work out what money do you have available for a deposit, what kind of deposit would you need, what percentage would you be putting down, 5%, 10%, 15%, etc. And what does this all mean? What's the difference? They are the things that we're going to cover in this video. First, let's understand why the lender requires that you put down a deposit at all. Why won't they just lend you the full amount of money you need to purchase that property? Well, the reason for this is best explained with an example. Let's pretend you purchase a property for £100,000. If the lender lends you the full £100,000 to purchase that property, and then you stop paying for your mortgage, the lender, as a last resort, could repossess that property, and then they would sell it to get back their money. But to get back their money, they'd need to sell it for the full £100,000. This could take time, and the lender doesn't want that. They want the money. What's more is it's possible that the value of the property could have dropped. What if they could only get £90,000 for the property? Then they'd be out of pocket £10,000. If they'd lent you £100,000, they've then repossessed the property because you stopped paying your mortgage, and they can only sell it for £90,000. They've lost £10,000, and of course, that's not good business. This is the reason the lender will require that you put down some of the purchase price yourself. So if you were purchasing a property for £100,000 and you were putting down a 10% deposit, that means you'd be putting in £10,000. The lender would lend the other £90,000. That way, it's less risk for the lender. If you stop paying your mortgage and one day they have to repossess your property and sell it, well, if the property is worth £100,000 when you bought it, they'll hopefully be able to get £90,000 at least by selling it, which means they get their money back. Because of this, often the larger deposit you put down, the lower interest rate you will get. Of course, that depends on the lender and the deals that they have available, but generally you'll pay a higher interest rate for a mortgage that you put down a 5% deposit on than you would if you could put down a 10, 15, 20% deposit. It's at this stage that I should explain something called loan to value, or LTV. Now, loan to value is essentially the percentage of the value of the property that the lender is going to lend you. So, if you purchase a property with a 5% deposit, your loan to value is 95%. The lender is lending 95% of the purchase price. You are putting down 5%. If you put down a 10% deposit, the lender lends the other 90% of the purchase price. Your loan to value is 90%. The lower your loan to value, the less risk that is for the lender. If they are lending you 95% of the value of that property, and the value of the property drops dramatically and then you stop repaying your mortgage, they might find themselves not being able to get back all of their money. Again, the example, you purchased a property for £100,000, you then stopped repaying the mortgage, they repossessed the property, but the value of the property's dropped and now it's only worth £90,000. Well, they're still going to lose money. They've lent you £95,000 and they can only sell it for £90,000. They've lost £5,000. That's why a 95% loan to value would be higher risk than, for example, a 90% loan to value or an 85% loan to value. For this reason, the lower your loan to value, generally the lower interest rate you'll pay. Of course, this depends on different deals from different lenders, but speaking very generally, you'll get a lower interest rate if you could put down a 10% or a 15% deposit than you would if you just put down a 5% deposit. Now, you might have noticed that with every example, I'm talking in multiples of 5. I'm saying a 5% deposit, 10% deposit, 15% deposit, 95% loan to value, 90% loan to value, 85% loan to value. And there is a reason for this. We know that we can sometimes qualify for lower interest rates if we can put down a bigger deposit, but that is generally based on multiples of 5. So if you put down a 5% deposit, you might get one interest rate. If you put down a 10% deposit, you might get a different, lower interest rate. But if you put down a 7% or an 8% deposit, well then generally you'll fall into the same category that you would if you just put down a 5% deposit. So you get the same interest rate and the same product from the lender. You'd only then qualify for different products if you manage to get up to the 10% threshold. So they generally go in thresholds of 5%. 5% being the minimum, 10% meaning you could get a lower interest rate, and of course if you could get up to even more, 15%, 20%, then you might find yourself getting even lower interest rates because of that. Of course, all of this depends on the lender's products that are available and the current market, but generally you might find that if you could get up to a 10% deposit rather than a 5%, you could find yourself getting a much lower interest rate. So it's always worth checking the different products that would be available based on the different deposit or the different loan to value. The loan to value can also impact the likelihood of you being accepted for a mortgage. If you are looking for a mortgage at 95% loan to value, but your credit history isn't great, you might find that you're less likely to be accepted by some lenders than you would be if your loan to value was 90%. In some cases, you might find that it's quite close, but you could probably just make it to the lower threshold of loan to value. For example, you might have £10,000 and you want to purchase a property for £100,000. You could then just make it to the 90% loan to value, which might mean you get a much lower interest rate and you'd prefer that product. However, in this scenario, you do need to consider other things as well. Are you leaving room for costs of moving? When you move house, there are costs involved, for example, solicitor fees, broker fees. Sometimes you'll pay stamp duty, which is a tax that you pay when you purchase a property. You'll also need to consider the other general costs of moving. For example, are you going to need to pay for a removal company? Are you going to need to buy furniture for your new place? In some cases, you might not want to put down all of your available cash for your deposit and then find yourself with absolutely no money when you move into the property if you need to buy furniture, etc. If you do find yourself in this position and you're not sure what size deposit to put down, it's just about weighing up the pros and cons. If you put down this size deposit, what product, interest rate, monthly payment would you have? And if you put down this deposit, what difference would that make with the product, the interest rate, the monthly payment? In some cases, it's just about weighing up the pros and cons. For example, would you rather pay a little bit more every month on your mortgage but have more cash to spend on the property? Or would you rather just put in more cash, get a lower interest rate, lower monthly payment, and perhaps save for a little while before you can afford to do the things to the property that you want to do? Of course, it's very important to make sure you don't leave yourself short for the necessary costs of moving, like the solicitor or stamp duty liability, things you can't really get around. Make sure you do have enough cash to pay your deposit and all of the fees involved with the move. Now in this video, I've talked mainly about 5%, 10%, 15% deposits. However, in some situations, it is possible that you might find yourself needing to put down a bigger deposit. Some lenders require a minimum deposit of much higher amount than this, and also some certain products, in order to qualify for them, would require a bigger deposit. For example, if you had some adverse credit issues, you might find yourself in a position where you can get a mortgage, but to qualify for that mortgage, you might be asked for a 25% deposit. This is also quite common in some situations, so it will, of course, depend on your circumstances. And that finalises my brief breakdown of deposits and how they work. Other than that, I wish you the best of luck with your move and many happy years in your new home.